Happy Monday and good morning to my real estate and mortgage friends. We have a big week this week with the CPI report for December coming out. But first, I want to talk a little bit about some of the data from last week. We had kind of a choppy week and probably a little bit of a confusing week. We had some people saying, oh my gosh, this job report is horrible, and other people saying this job report was great news. So let's break that down a little bit. First of all, we got employment figures that the economy added 223,000 jobs last month, which is down from some of the numbers earlier in the year, which shows that job creation is slowing, but unemployment dropped to a 30-year low at 3.5%. And so we've got sort of some conflicting information there that caused the markets to get rattled and caused mortgage rates to get worse for a little bit and caused the stock market to pare some of its gains. And then the very next day, we got an additional job reports out that showed that wage growth, which is really what the Fed is paying attention to, is slowing, continuing to slow. The year-over-year number in December was 4.6%, which I believe was the third month in a row that it's dropped. So we're seeing wage growth slow, which is a precursor to employment slowing down. So we're heading in the right direction. It's just slower than we want. Everybody wants it to move more quickly. But take a look at this chart that we've got over here with wage growth. You can see that it appears that it has plateaued earlier this year and is consistently coming down now for several months in a row, down to 4.6%. And keep in mind, anytime we look at these year-over-year numbers, they're taking in 12 months worth of data. So each month where we see a slowdown, whether it's inflation or whether it's wage growth, it's sort of muted because it's averaging the 12-month total. So it's going to come down slowly, but it's heading in the right direction. The good news is when we have momentum heading in the right direction, it's likely that it's going to continue moving that direction for some time for that same reason. So let's talk a little bit more about the employment versus wage growth conversation. How is it possible that unemployment is dropping and yet wage growth is slowing? It's kind of a mixed signal, right? Well, if you think back to the pandemic and coming out of the pandemic, employers are having a really tough time finding enough workers. And at some points we had over 2 jobs available per worker. And so when that happens, employers start offering more perks and more pay and signing bonuses, and they start getting really aggressive to try to fill those positions, because if you are short on workers, it impacts your ability to conduct business. Coming out of that time and things starting to slow down a little bit in the economy, employers are really hesitant to discontinue hiring or to lay people off because they don't want to get in that same situation again. So what I think is happening is you first start to see it in the wage growth, because while a company may not be willing to lay somebody off, or they may not be willing to take down job postings, they might be a little bit less likely to pay a premium wage for that position. So we start to see wage growth slow first, and then I think the next thing we're going to see is unemployment start to reverse course and start heading up. And the fear is obviously that unemployment takes hold and grows at a much more rapid pace, but we have a long way to go before we get to that point. So keep an eye on wage growth. We're going to keep an eye on employment and unemployment. And really what the Fed wants is to see all of the indicators moving in the right direction. And I think we're going to be there soon. All right, so if we jump over now to talk a little bit about CPI, we have a CPI report coming out on Thursday. This is the big one. This is what everybody's looking to see, a continuation of inflation improving. All signs are pointing in the right direction. Currently, the forecast for December is a 0.1% month-over-month gain. If you see that that's consistent with November, that's, again, continuing to move in the right direction. But really what we want to pay attention to, again, we say this every month, we're going to replace December of 21 with December of 22. And if we do that, we're going to pick up somewhere around 0.5%. You'll see in the top right corner here, I've got a 6.6% figure. If we do, in fact, hit 0.1% monthly, the annual number for December will end up around 6.5 to 6.6, which is down from 7.1 in November. So again, another meaningful improvement. And looking again at this chart, January's got 0.6, February's got 0.8, March we get to replace 1.2. So all signs are leading in the direction that inflation is coming down. And again, coming down more quickly than most people think. Circling back to some comments that we made earlier about inflation, the two things that have been buoying inflation, have been causing it to be sticky, to use the Fed's term, or the cost of housing and wages. Wages are starting to improve like we talked about earlier. So the next thing we're paying attention to, the first thing I'm going to flip to when we get the CPI report out, is what is happening to shelter costs. Are they plateauing? Are they slowing down? Are they heading in the right direction? That's the last domino to fall. Once housing costs start falling in line, assuming everything else keeps moving in the right direction and we don't have some world event that throws us all into a tailspin, we're going to start seeing the Fed change their tone. That's my prediction pretty soon. So I think we're going to be in for a big report on Thursday. We will be putting up another video as soon as that comes out, breaking down all the details. As you can tell, I'm excited about this week because I think this is a week where we finally put a nail in this coffin. Be sure to like and subscribe in KFA. So there's a few things that there's a lot of things you said there. So first of all, real wages have not kept up with inflation because inflation's been out of control. Wage growth, spiked because of some of the things we were just talking about with respect to not enough people to fill all the jobs. So employers start paying a premium trying to fill their jobs because they'd rather make less margin per unit than not be able to provide the units at all, right? So they're going to pay a premium, but now we're starting to see that premium decreasing, which is good for slowing down the economy and reducing inflation. It's bad for the workers, though. But part of the reason why, and this is what I was talking about, the Fed doesn't even look at the supply side of things. They're only looking at demand. When we dumped all this money into the economy and all these people got, stimulus checks, or they didn't have to pay rent for a while, or, whatever the mechanism was that they received money, the PPP loans and all this stuff, we gave people the ability to spend without their wages increasing to pay for it. And so we had this cycle, this time frame where we had all this money being spent, and it wasn't being fueled by wage growth. And so that caused prices to spike. And that's the reason why initially the Fed said it was transitory, and they got vilified for saying that. The reality is, and people don't want to say this inflation is transitory. It's just taking a lot longer to work through the system than they thought it would. This inflation is purely caused by the pandemic, supply chain disruptions, and all the money that we threw into the economy. It's not caused by the economy overheating per se. That contributed to it, but really it overheated because we threw all this money at it.
I guess what my thought was, I feel like the inflation was directly caused by the Fed printing trillions of dollars.
That was a big part of it. It wasn't just the Fed though, but yes. So the Fed goes back and looks at their playbook for how they dealt with inflation in the past. Well, most of the other inflationary events that they've dealt with were caused by normal market conditions, not a pandemic, right? When a pandemic occurs and our supply chains get destroyed overnight, and then all of a sudden governments across the world in a variety of ways throw a ton of money at the situation to try to avoid an economic collapse, we created a situation where we had all this money in our hands and we had less products to buy. More money, less products. That causes the price to go up. That's it. I mean, that's basic economics 101. And part of it was the Fed, subsidizing interest rates in the housing market to try to use the housing market to stimulate the economy because it worked so well, during the dot-com bust that they went back to that well. But it's also the PPP loans. It's also the rent subsidies. It's also, we went a whole year without being able to evict tenants if they didn't pay their rent. Well, you let people go without paying their rent for a while, they're going to do something with that money. So they go and they spend it on goods. And it just creates a bidding war, and that's what caused inflation. So however you want to look at it, it's transitory. It's just a long transition.
So transitory, by definition, means that the inflation is temporary?
Yeah, that it would, all things considered equal, would most likely work itself out on its own. That's the thing right now. The Fed thinks that they're causing inflation to come down as quickly as it is. They're not.
Because my thought is okay, prices are so much higher now. People have much less buying power. At some point, they're not going to be able to afford these products. But if prices come down, that's technically deflation.
Yeah, that might be coming.
And that's what I'm getting at is either we stay in inflation and wage growth continues, or there's the unemployment, people can't afford stuff, prices come down. It's like with the housing market going up 20-25% in a year. If we see a 25% decrease, you're still up from where you were before. Yeah. Technically, that's steep deflation.
Right. Well, and the thing is the Fed's, the
and
balancing act.
Deflation is the bad thing. You don't want to ever have that, but I feel like it's kind of necessary here.
I think what you don't want is systemic deflation. So right now, for example, used car prices are dropping. Nobody thinks that's bad. Home prices are coming down a little bit. Nobody thinks that's bad. But if everything starts coming down and it creates a cycle, then wages start going down.
So that's negative inflation.
Deflation.
Deflation.
Yeah. But it's when it becomes widespread and systemic, that's when it's problematic. Same thing with inflation. The reason why the Fed's being so aggressive right now is they don't want this to take hold and become part of a permanent cycle where you have to increase wages in order to keep affording products. So what they're trying to do is slow down the supply or the demand side of things. But they're not taking into consideration a large chunk of this inflationary cycle was caused by supply chain disruptions. It's also all the money. I'm not discounting that. They put way too much money and they overshot the runway by a long shot.
Well,
but it was their first pandemic, right? So can't really.
When you force people not to be able to work, then you create this giant cluster.
But my point is, and I think what we're going to see as we look back on this, and I'm glad you're recording this because at some point I'm going to say, look, I told you this. Because I could be wrong. But from what I see in the data and how fast things are coming down and what we're seeing, and I forgot to even talk about this, but in Europe, they're seeing inflation come down faster than they expect, and they're just scratching their heads going, what's going on?
Well, my question was also with the Germany numbers that came out, what do they actually count in their inflation numbers? Because
I would have to look into that. I don't know.
Because compared to what the Fed or what the U.S. does with shelter costs, them calling people saying, hey, what would your house rent for? Like, what is Germany tracking so that their numbers are so substantially?
Well, I would be curious to learn that myself. I suspect it's fairly similar to what we do because a lot of these, developed nations kind of follow the same patterns. There's probably some variances, but as long as they're measuring the same thing today that they measured last month and the month before, you get to see kind of a broader picture of what's happening. And the point being is that if inflation is decreasing, the rate of inflation is decreasing faster than the economists in these countries can predict, it stands to reason that the most likely outcome and the most likely cause is because they're not taking the supply chains into consideration, which I've been saying for a year now. They're only looking at the demand side because that's the only thing they can control. They don't look at the things they can't control. It's the same reason why the Fed likes to use core CPI, because they can't control gas prices. They don't have any impact on that. They can't control energy costs. They don't have any impact on that. So they don't like to look at that number because it doesn't allow them to have their tunnel vision focus. But the problem with their tunnel vision focus is this issue is not a normal economic issue. It was caused by a freaking pandemic. And they're still looking at it through a tunnel vision going, the only thing we can do is drive rates up or down. And it's like, dude, pay attention to what's happening. The economy is slowing down. We haven't seen jobs slowing down yet because employers are terrified to go through what they just went through for the last 2 years. Where we made less money, not us, but companies made less money because they couldn't get butts and seats to do the jobs to make the products to sell. They couldn't get people to work. There wasn't enough people. And so they're not willing yet to let go of people. They're not willing yet to stop trying to fill those positions because if we do get a soft landing, they want to be ready to go. That's what's happening. That's the reality on the street. But the Fed doesn't see that. The Fed just goes, employment's not going up, so we got to keep raising rates. And that's irresponsible. And that's what people are starting to bark. I mean, now it's getting to the point where, people in Congress are starting to what are you doing? People at, Goldman Sachs, Bank of America, and some of these large institutions are like, what are you doing?
By increasing rates.
Yeah, you need to pause right now. Stop with the rhetoric. Stop talking. Look what happened last week. They released the Fed minutes from December from their meeting. It was over a month old. Almost a month old. 3 weeks old. We read those notes and digested it, and it was negative, hawkish. Fed saying inflation's going to stick around for a while. We're going to have to keep raising rates, and the market reacted to that printed transcript of their meeting, where they're being hawkish. What I'm saying is, and what a lot of people, the chorus is growing, is that they're not listening to what's happening. They're not looking at the actual data in a comprehensive manner. They're only looking at unemployment and core CPI and PCE. They need to look at a more holistic approach, like we've talked about before. When it comes to the housing, the shelter costs, they're looking at the wrong data. Okay, when it comes to employment, unemployment is not as important as wage growth when it comes to inflation. Wage growth is what matters. And so right now we've got a situation where unemployment is moving in the wrong direction, I think temporarily. Wage growth is moving in the right direction. So if we have wage growth moving in the right direction, we have inflation moving in the right direction. If we see shelter costs plateau or shelter costs start coming down, at what point do you say, hey, we're heading in the right direction, maybe we should stop and see how this goes for a little bit? That's the argument being made right now.
And yeah, because there's 3 phases to what the Fed's actions are, and we're still not out of phase 1, which is the increase in rates. Phase 2 is stop raising rates and keep it where it's at for a bit, see what happens. And phase 3 is lowering rates again.
Well, phase 3, I would say, would be smaller adjustments based on data. So this is a great point to bring up. So the first phase is the Fed, responding to whatever the situation is, and they've been widely criticized because they waited too long. And I think they were the only ones who didn't think they were waiting too long to respond, because they believed at the time, and I think they still do believe, but they won't admit it, that this inflation is transitory. And the reason it's transitory is because it was caused by an external event that's not a recurring, consistent type thing. It's not going to keep happening. Hopefully. So the first phase is a reaction phase. So they're reacting to the the inflation situation that we found ourselves in and the fact that they waited too long. So they had to react very strongly. The second phase is going to be a phase where they pause and they watch. And what should happen if they do that correctly is that they start making small adjustments from there on out based on the data and not based on a reactionary, holy shit, we're behind, we got to catch up, we got to make sure, in more of a controlled, measured approach where, instead of, using a shotgun approach, they're using a scalpel and they're making small sort of fine-tuned adjustments. That should be what phase 3 looks like, and if they do it correctly. But to your point, and to what a lot of people think, is that they may have already overreacted, and once they pause and they see that inflation continues to drop, and and I'm not predicting this, but this is what some people think, they're going to pause. They're going to see inflation continuing to improve, and much like Europe, you might be kind of scratching their head, going, "Why is it still getting better?" And again, it's because they're only, they've got a polynomial equation, and they're only looking at one of the variables. And so then we start seeing unemployment go up, and now it starts to get uncomfortable. And at that point, the argument that's being made is that they're going to have to reverse course. The concern being that they wait too long, like they always do, and now we get ourselves into a recession that's deeper than was necessary. That's the concern that most people have. At the end of the day, we might see a scenario where wages and inflation, home prices, and all these things are flat for a while. So if we can have 5 years where inflation's flat, home prices are flat or really low, but wages can keep growing, that's how we get into a better scenario.